December has a pattern for investing. Going back almost a century, the S&P 500 finishes the month green about 75% of the time. And the Santa Claus rally, which is the last 5 trading days of the year, has been positive roughly 80% of the time. That happens to be one of the few seasonal trends that we're all hopeful holds up. So if the market wants to give us a little tailwind, hey, I'm going to use it. But I'm not spreading that across the whole market. I'm putting it where the real growth is happening today. So it's in data centers, AI infrastructure, and power production. These areas are posting some of the fastest revenue growth in the market, and they have multi-year demand already locked in. So heading into 2026, here are the names that check out on the fundamentals and the technicals, and they're the ones that I'm paying the closest attention to right now. And before we jump in, here's how I'm going to be grading these names. I happen to use a simple scoring model that keeps me honest. It cuts out the opinions and it looks at 4 things that actually move the stock prices over time. And that's valuation, financial strength, technical momentum, and trend direction. And on valuation, I'm looking at things like the PEG ratio, the price to sales, and the free cash flow yield. And on financial strength, I care about margins, revenue growth, and how a company handles its balance sheet. And then at the end, I layer in the technicals because timing matters just as much as picking the right name. And finally, trend direction. That's where ADX and ROC come into play. They're the signals that tell you if buyers are in control or if they're stepping into a lot of traffic. And of course, I'm not going to be throwing all of that out at every single company. I'm only pulling in the signals that actually matter the most for the stocks right now. That happens to be my filter. Now let's get into the list. Our first company is Nebius Group, building GPU as a service infrastructure for AI training and inference. Think of them as a foundation for AI where companies need massive compute power, but they don't want to build out their own data centers. The company secured about $20 billion in long-term contracts. That includes a $17.4 billion 5-year deal with Microsoft and roughly $3 billion with Meta. Multi-billion-dollar agreements locked in before the infrastructure is even fully deployed. Right now, Nebius is burning cash today to build capacity that's already contracted for tomorrow. The company is deeply unprofitable today as they begin to build out the data centers across Europe and the US, but they've got billions in contracted revenue once facilities go live. In fact, NVIDIA invested in them December of 2024, taking a 0.5% stake. Their management projects annualized run rate revenue of $7 to $9 billion by the end of 2026. If they happen to execute on that kind of a build-out, the contracted revenue provides a clear path to profitability. This is a pure infrastructure story. Negative cash flow right now, but with revenue visibility that most CapEx-heavy plays never really get. They also have strong technical momentum despite the cash burn. Analysts give Nebius Group 101% upside over the next 12 months. Our next company is Cameco, one of the world's largest uranium producers, and uranium is the fuel for nuclear reactors. That simple fact matters more now than it has in decades. Tech companies need massive amounts of reliable, carbon-free power for AI data centers, and solar and wind can't provide the baseload power that these facilities require. But of course, nuclear can. Literally just a couple days ago, the Trump administration closed a $1 billion federal loan to restart 3 Mile Island's nuclear reactor, and it's exclusively to power Microsoft's data centers. That's the US government directly financing nuclear restarts for AI infrastructure. And going back to October of this year, Cameco, alongside Brookfield Asset Management, entered an $80 billion strategic partnership with the US government to accelerate deployment of Westinghouse nuclear reactors. The government will facilitate financing and permits, and Cameco owns 49% of Westinghouse. And the current administration aims to quadruple nuclear energy output over the next 25 years. The uranium market was well undersupplied before AI demand even showed up. And now the supply-demand imbalance is intensifying. Google, Amazon, and Meta, they're all signing nuclear power deals today. Cameco controls critical uranium supply at exactly the moment nuclear renaissance is shifting from theory back into reality. Analysts give Cameco 33% upside over the next 12 months. But first, let me introduce the sponsor of today's video of 21 Shares, which is recognized as one of the world's leading crypto exchange traded product providers. Their mission is to make it easier and more accessible for everyday investors to gain exposure to digital assets. Having followed the crypto markets for years, I've seen several investors hedge against the erosion of the dollar with a small allocation of crypto within their portfolio. portfolios. And I have to say, I appreciate that 21 Shares aims to bridge the gap between traditional finance and crypto. They offer fully collateralized and registered investment products traded on global exchanges, including exchange-listed products that track major digital assets such as Bitcoin and Ethereum. 21 Shares maintains a deep focus on transparency, compliance, and the investor education. You can easily check their website for the fact sheet or the insight section to learn so much more. If you want to stay ahead of the curve on all things crypto, subscribe to the 21 Shares newsletter to get market insights and trend breakdowns. The link is down in the description, so go ahead and check out 21 Shares today. And of course, this is not financial advice, and all investments carry risk. Our next company is applovin, which has become one of the most dominant forces in mobile advertising by building an AI that essentially prints money. While most investors know them for mobile gaming ads, what's happening behind the scenes is transformative. Applovin's Axon 2.0 engine predicts with stunning accuracy which users will download apps and engage with them. When Apple's privacy changes crushed most ad platforms, applovin rebuilt their entire system around the machine learning models that didn't rely on tracking individual users. And the result? Complete market dominance. In Q3, they delivered $1.4 billion in revenue. That's a 68% jump year over year. But here's what really matters. Their adjusted EBITDA hit $1.16 billion with an 82% margin. They're printing $1 billion in free cash flow every quarter, and that's up 92% year over year. And their net income reached $836 million. The company got added to the S&P 500 in September, which triggered massive institutional buying from index funds. And they authorized an additional $3.2 billion in share buybacks and are aggressively retiring shares with free cash flow. And in October, they launched their self-service advertising platform, taking that same AI technology beyond just mobile gaming and into broader e-commerce. Early advertiser spend is growing 50% week over week. Analysts give applovin 50% upside over the next 12 months. Now, I do want to point out that they have been in a lawsuit over data collection practices, and that could be a very bumpy road over the next year. Either they lose and the stock takes a hit, or they aren't, and hey, the stock gets a little bit of an extra boost. For me, I'm just going to let it ride and see if there's any impact. Our next company is ARM Holdings, and they don't make the actual chips, they license the architecture that powers them. Every iPhone, most Android devices, and increasingly data center servers run on ARM-based processors. It's a royalty business model on the backbone of modern computing. Recent Q2 revenue hit $1.14 billion, and that was up 34% year over year, and marking the third consecutive quarter above $1 billion. And royalty revenue reached $620 million. That's up 21%. It's driven by higher royalty rates per chip and data center royalties that doubled year over year. ARM is genius because they essentially get paid twice. They get paid once when someone licenses their design, and again as a royalty every time a chip using that architecture gets shipped out. I think we all know that the data center transformation is accelerating, and ARM-based server chips deliver dramatically better power efficiency than traditional x86 processors. Google's ARM-based Axion chip delivers 65% better price performance while using 60% less energy. Amazon Web Services, Microsoft, Google, and NVIDIA, they're all developing ARM-based chips for data centers. Microsoft expanded ARM-powered Cobalt 100 to 32 regions globally. NVIDIA secured over $500 billion in expected orders through 2026 for ARM-based Grace Blackwell superchips. The company's also a strategic partner on the Stargate project, which is a $100 billion AI infrastructure initiative alongside Microsoft, NVIDIA, and OpenAI. ARM is positioned at the intersection of mobile dominance and data center transformation. Analysts give ARM a 44% upside over the next 12 months. Our next company is Applied Digital, building GPU as a service infrastructure for AI training and inference. When companies need the massive compute power, but they don't want to construct their own data centers, well, that's where Applied Digital comes in, and they build the facilities and they lease them the capacity. The company secured approximately $16 billion in long-term contracts. Now, that includes an $11 billion deal with CoreWeave for 400 megawatts and a $5 billion 15-year agreement with an unnamed U.S. hyperscaler for 200 megawatts. So they have multi-billion-dollar agreements locked in before the infrastructure is even fully built and deployed. Now, the challenge is Applied Digital is burning cash today to build capacity that's already contracted for tomorrow. That means the company is deeply unprofitable as they construct data centers across North Dakota. But they've got billions in contracts contracted revenue once facilities go live. NVIDIA invested in them September of 2024, and an asset management company committed up to $5 billion in project financing to fund this build-out. And their management expects their first 100 megawatts of their Polaris Forge 1 campus to come fully online any day now, with a full 600 megawatt capacity across both campuses operational by 2027. If they happen to execute on that build-out, then the contracted revenue provides a very clear path for profitability. To me, this is a pure infrastructure story. Yes, they have negative cash flow right now, but with revenue visibility that most CapEx-heavy plays really never get. And they have strong momentum in securing those big hyperscale customers before competitors can even deliver capacity at any form of scale. Analysts give Applied Digital a 117% upside over the next 12 months. And moving on to our next company, which is Arista Networks, and they build the networking backbone that makes AI data centers actually work. When Microsoft, Meta, and Google build massive AI infrastructure to train models like GPT or Llama, they need networking equipment that can handle the insane bandwidth demands of moving data between thousands of GPUs running all simultaneously. And for the most part, Arista owns that space. In Q3 of this year, their revenue hit $2.3 billion, and that was up 27% year over year, marking their 19th consecutive record quarter. Now, Arista's software-driven approach delivers gross margins that are well above 65%, compared to traditional hardware vendors that are stuck around that 20 to 30% range. Once a company deploys their particular platform across the data center, the switching costs are just too massive. You don't just swap out Arista for a competitor, your entire network architecture is built around their operating system. The company crossed $1 billion in quarterly operating income for the very first time. They've expanded partnerships with NVIDIA, AMD, and OpenAI, building products specifically designed for AI workloads. The AI infrastructure build-out is accelerating, and Arista is positioned to capture a significant portion of that network spend as hyperscalers pour hundreds of billions just into these data centers. Analysts give Arista Networks 46% upside over the next 12 months. Our next company is Meta Platforms, the parent of Facebook, Instagram, and WhatsApp, where I won't even go into too many details about what they do because I think most of you know. So in their latest quarterly earnings, they took a lot of flack for their AI spending. And me personally, I think it was a little bit of an overreaction. I'll point out that Reels now accounts for 50% of all Instagram screen time. Time spent on Facebook increased 5%. Threads jumped 10%. Meta's AI ad targeting allows advertisers to reach users with precision that TikTok just can't match. Now, there's one item from their fundamentals that I really want to point out, and that's their PEG ratio being at a 0.38, which indicates that it could be extremely undervalued, which is unheard of for a mega cap this size. With their recent pullbacks the past few weeks, they're sitting in a solid spot for some very long-term growth. Analysts give Meta a 43% upside over the next 12 months. Now, when you take a moment and you zoom out, each of these companies sits at a very different point on the entire curve. Some of them are absolutely pure growth, and some are cash machines. Some are infrastructure bets that only pay off if AI demand keeps compounding year over year. And that's why I use my scorecard, because it cuts through the hype and it kind of shows me what's actually working. It's revenue strength, it's margin quality, cash flow, the trend direction, and the valuation sanity. And if you pick your entry point using technicals, then hopefully you tilt the odds even further in your favor. For me, there's no reason to guess. Like, you just need a system, and this one for me puts the math in my favor. So I do have each of these in my own style of ranking, where I'm only looking at valuation, financial quality, and the technicals with a little bit of trend. In this case, applovin surfaced to the top and Meta was right behind it. Then we have Arista, ARM, and Cameco. And then of course we rounded out with Nebius Group and Applied Digital. Now, I'm trying not to let analyst forecasts persuade my decisions, but I truly try to rely on the data. Now, I hope that you were able to get some value out of today's video, and as always, thanks so much for watching.